So you want to buy dividend stocks because you want to get paid periodically while you hold on to the stock. But you may worry that the company might decrease their dividend payout during bad times. Because if the company isn't making money, then they don't have any money to pay shareholders of the dividends. Well, luckily, there are companies out there that have increased their dividend payout every year, even during recessions. If you go to dividend.com, you can get a list of stocks that have increased their dividend payout for at least 10 years. But you need to make sure you pick the right ones. I'm not going to tell you which stocks to buy, but I'll give you the tools you need to pick the right ones.
Okay, so first you want to go to dividend.com, and here you are on the homepage. Next, you're going to hover over strategies, then click on right here, 10-year dividend increasing stocks. You're going to get a list of all the stocks that have increased their dividends for over 10 years, and unfortunately you can't export it to Excel because you have to have a membership. What we can do instead is just go ahead and copy and then paste it into an Excel sheet. So after you paste it into your Excel sheet, you should get this right here. So the first thing we want to do is we want to find out how many recessions each stock has gone through. So we're going to add another column. We're going to call it start year of increasing dividends. And then we're going to, the year is 2020. And then we're going to subtract it from the number of years these guys have increased their dividends, and then we're just going to fill that up. And so we're also going to sort this number of years from largest to smallest. Okay, so you want to add another column, and we're going to call it number of recessions. So we're going to count the number of recessions each stock has gone through. So the next step would be to go to Wikipedia and just look up list of recessions in the United States. Here you scroll down into this part where it lists the more recent recessions that we've had. So we can see that the first stock started increasing the stocks in the dividends in 1955. So if we go to here, we can see that there was a recession. The first recession after that was here starting in 1957. So, and then the next recession wasn't until 1960. So we need to count the number of recessions that's gone through. So for the first one, it started in 1955. So it's gone through 1, 2, 3, 4, 5, 6, 7, 8, 9 recessions. Okay, so we know that the next recession didn't start until 1960. So we can highlight all the way until we get to 1959 right here. So now the next recession right here started in 1960, and then the next recession after that didn't start until 1969. So we know by deduction that it went through 8 recessions. So we can put 8 right here, and then we can go all the way to 1969 because that's when the next recession started. So going to that one started in 1969. The next recession started in 1973. So we're going to go 7 right here. And then go all the way down to 1973. And so forth. So we're going to lump everything from 6 recessions above into just 6 because anything beyond that doesn't really make a difference. So you should have something that looks like this after you delete the other column that says the start year of the increasing dividends because you don't really need that. Next, we're going to eliminate any stocks that have not gone through recession. So we're going to eliminate 0, just like that. Next, we're going to take the dividend yields and we're going to group them into tiers. So we're going to first find the average of all dividend yields. Okay. And then we're going to take the standard deviation of that same group. Okay, so we're going to input the average number right here into the mean row. So we're going to add this, the average, plus the standard deviation. We're gonna put a dollar sign right there just to lock it as we drag it. And then we're just gonna keep going up. And then same with here, but we're going to get the bottom tier. So it's the average minus the standard deviation. Okay. So next we're gonna start color coding them just to make it easier. So personally I like to go dark green. Just work my way up. Red. So we're going to range this from large to smallest. And then anything above 12.32%, we're going to color code with the same color right here. This one. And then the second tier, anything between 9.36 and 12.31, I'm going to color code it. Anything below 3.42, we just want to mark it as red because those are unfavorable. So you see as the numbers change, I change my color to a lighter shade, indicating that the darker it is, the more favorable the stock is. Okay, next we want to go and rearrange them from, I like to rearrange it from number of recessions as the first one, then dividend yield is the second one, the number of years is the third one, and then the price as going from small to largest as the fourth criteria for rearranging these. So here we are. So once you get here, you can basically filter out anything that's red. So we know that the average for the dividend yield is 3.42. So we're going to go ahead and filter out anything that's above 3.42%. So basically, the more green it is on these two cells, the more favorable it is. So like, for example, this stock, Universal Corp, that's looking pretty good. And then Helmerich Payne, that's looking pretty good as well. And then 10-year factory outlet, REIT, Real Estate Investment Trust, that's looking pretty good. Same with these ones as well. But we're going to cover on what further investigation you need to do before you just pick out the stocks with the highest number of recessions they've gone through and the highest dividend yield, because there's more to that.
When picking a stock out of this group, I typically like to go through 3 criteria points. 1, it has gone through at least 2 recessions. It's a good indicator on what they'll do for the next recession. 2, is their payout ratio below 100% for most of the last 5 years. This tells us if they're earning enough cash to pay the dividend payouts. You can find this on Morningstar.com. And the 3rd, are they in a business that isn't going obsolete? An example of a business that is going obsolete would be a real estate investment trust that owns a lot of malls, and those malls are starting to decline as far as tenants because they're getting replaced by online retailers. So happy hunting, guys. Hope this helps.